Hi, thanks so much for joining me on this special broadcast of the Mutual Fund Show. Equity markets have seen significant volatility this week. It's been a bit of a roller coaster ride. A sharp run-up on Monday, a crash on Tuesday, and a recovery today. Where does that leave you if you're investing in mutual funds? There's something that gets said quite a bit in Mumbai, and I think it's relevant today. Kaiko tension lene ka? If you had not looked at your portfolio this week, you likely would have slept better, and chances are that you'd be more or less where you were last week. But it's still important to know what the trends are and how you should react. And to that end, I spoke to Swarup Mohanty of Mirae Asset and Trideep Bhattacharya of Edelweiss AMC and began by asking whether their fund houses saw increased redemption pressure this week.
No, actually, it was as per predicted. I mean, we've been seeing this reaction for a long time, and the faith of the Indian investors on long-term equity investments were reaffirmed yesterday. Day before, of course, there were a lot of questions, rightfully so. But yesterday, we saw inflows across funds. I mean, both active, passive factors to our market cap ETFs to our active funds. We saw inflows across. It's a good thing to see, that investors are changing their stand in the market and looking at opportunities to deploy, which was such a refreshing day yesterday. We went back happy, actually.
Okay. Trideep, did you see, what was your experience? Because it's counterintuitive, one would say, in a market that saw the benchmarks fall 6%, the broader markets lose ground as well. Swarup saying his fund house saw inflows.
So actually, I would agree with that. I mean, we also saw inflows across strategies and across so-called segments of equities. And I would sort of put the context as that heading into elections, there was a bit of a volatility in terms of the vote count. Of course, the exit polls caused one-way outcome. But if you go to basically days before that or a month before that, we saw a bit of volatility in and around the market. So I think markets went into it a little light. FIIs were obviously massively short, but on the other side, the positions were reasonably balanced. We saw volatility coming about, but I think there were the shaky hands had a bit of a time to sort of do so before. So hence, yesterday, when the markets crashed quite a bit, we actually did see inflows. The final thing that I would say on this is net. Yesterday's closing Nifty levels is same as what we saw in early May. So barring the exit poll drama and the subsequent reality, we are not far off in terms of market levels.
Equilibrium is sought and found often in these cases, but it's heartening to see two large fund houses tell me that they saw inflows on a day where you saw such frenetic selling, and that to me indicates that the mutual fund investor by and large is learning to be more pragmatic and focused on the long term. From the fund manager's standpoint, and from wearing the hat of a fund manager, Trideep, I'll come to you on this one. How do you navigate this and how are you approaching this? Because yesterday would have presented several opportunities with stocks falling, 20-25% in certain cases. Is that a buying opportunity, or do you wait for the dust to settle just a bit?
So I think the practical answer is a mix of both. What we do is we never buy full in one go, and at the same time we don't want to leave too much for the later. But I think I see objectively this event as an excuse for correction in valuations of those companies where the valuation multiples had really kind of shot up, given they were in trend, so to speak. And if you take that valuation correction away, I would say net between a month ago and now, most likely 99%, we have a same government. We will probably see the key ministries remaining the same, and hence maybe we have a coalition government, and hence maybe to a certain extent they might have to be a little tweaking in the policies. But little tweaking in the policies is very different from policy reversal, which the market seemed to be worried about yesterday. So from a medium-term standpoint, the earnings potential don't really change. It is just that what valuations in some of the in-trend areas, they have taken a haircut of about 20-25%, which in the grand scheme of things is quite healthy, is the way I would think about it.
Okay, so that's the fund manager perspective. Swarup, you've got your ear to the ground and you speak to a lot of large investors as well. The smart money, one would assume, does what Trideep is doing with his funds, which is to deploy selectively and to deploy strategically and take these opportunities to average your cost. Is that the right approach?
Yeah, absolutely. I mean, there's no doubt or debate on that one, because at the end of the day, it's this average price that will define, and how much you accumulate at that average price will define the wealth you accumulate. And that's what we tell all investors also. If you are ready to buy day before on some government formation news, you should be buying more today at these levels. Now, there are two types of people in the market. The seller wants the market to go up. The buyer wants the market to go down. You have to decide who you are. If you are a buyer, then if the market goes down, you should be happy. And then many people sort of keep it simple on that philosophy and continue buying this long-term story called India.
Okay. Last couple of questions, gentlemen. Trideep, some of the froth that people were talking about and have been speaking about all of this year seems to have been skimmed off. Would you say that that would be a fair assessment? And do you anticipate at all that there could be a shift in the kind of flows that come into mutual fund schemes? Is that something that you are preparing for in the broader end of the spectrum at least?
Look, I mean, I think overall the way, I'll give you an answer in a roundabout way. Flows is an outcome of how the companies or the market, or how the market does. Market is a function of how the earnings do. And between flows, market and earnings, the more predictable one is the earnings. And there I would say that the earnings story of India, which was robust, will continue to be robust. The fact of the matter is that the capacity utilization of India Inc., which was hovering around 77-78%, will not change dramatically within a day or two. And hence, the shape of the capex cycle may be too pronounced or less pronounced, but in some form or the other, you would see capex coming through. The power deficit scenario that we see is very much a function of where supply-demand scenario is in that segment. That is going to kind of, work its way in the earnings of companies which are exposed to the same. That doesn't change between 1 week ago and where we are now. And likewise, the real estate sector, where inventories are at a 10-year low, that doesn't change because the person occupying the seat has a little less number of seats than where things were about a fortnight ago. So if I put these things in terms of companies that are exposed to these areas, clearly the earnings of segments which are linked to these will continue to remain robust, except that between yesterday and today, the valuations are about 20-25% cheaper. So when I spoke to people earlier, I said that it makes sense to be selective then. And now, given that the valuations are cheaper, it makes us look at those companies where we think earnings momentum is strong. The valuations made us stop. Now is a good time to sort of get in. So that is the target hunting area overall. That's one. In terms of the in-trend areas, like the areas that I talked about. Couple of new areas where we have added over the last 2 or 3 months have been basically in the anticipation of rural recovery and also a bit of monsoon being on time on the FMCG side. And we talked about it earlier on the IT. We've also launched the technology fund. That IT, the earnings are bouncing around the bottom. So those are the two areas that we have added to in the last 2 or 3 months, which is coming handy in these times. But net, a bit of portfolio repositioning we have done over the last 2 or 3 months. And now, given this correction in some of the in-trend areas, our hunting ground is those places where earnings momentum is strong, but valuations are now 20-25% cheaper.
Very quick follow-up question for you, Trideep. Are you keeping the powder dry? What is your cash management strategy right now?
Yeah, so I think we think that this volatility, on policy-related volatility, will be probably at its extreme now and will gradually resolve itself in a month's time once we get the the ministries announced and we have the budget. We are keeping our dry powder or powder dry to be just to sort of ease our positions through so that we don't overdo it in one go.
Okay, fair point. Swarup, last word. We've seen, barring yesterday's kind of crack, we've seen significant solidity and buying, as you both pointed out, you've had inflows on a day when the market cracked. So would you anticipate that this will continue to be the case and people betting on a significant fall for the equity markets in India might be betting on the wrong horse?
Yeah, I've said this in 2016 and I stand by that now, today also. Redeem India at your own risk, right? There'll be two types of people who strongly believe and have the conviction of India being a long-term story, which it is, and there's nothing taking away from anything from that story. Second, there'll be people who will, bet on event risk. Both have their own ways, and I'm nobody to comment on that. But if one wants to really benefit from the long-term India story, then one has to stay put in the story itself, right? Now, what has happened, and I can share that sitting with data also, is that we are a bunch of long-term investors because we've invested in the market for 15, 20 years. Unfortunately, making short-term investment decisions. That's why we don't catch the entire upside of the country. The sooner we reverse that, the better. It's at the own investors or advisors, call on how to take it. But it's impossible to build long-term. Trideep is along with me on this. He's the fund manager. I'm not. But he will bear with me when I say this. There's nobody who can predict. What you can predict is, yes, this country will go from 3.5, 4 trillion to 8 trillion. And you have to ride the journey till 8 trillion to get the benefit of that entire 8 trillion into your portfolio. Now, if you're going to time the market, call is yours. But leaving the market is easy. Entering the market may be very difficult.
That's a fair point. And one swallow does not a summer make. Gentlemen, thank you so much for taking the time and for speaking to us on NDTV Profit on what is actually an important day for the mutual fund investor. All right, and those two fund houses were not the only ones that saw significant inflows. I spoke with Akhil Chaturvedi, Chief Business Officer and Executive Director at Motilal Oswal AMC, and here's what he had to say.
Thank you, Alex. So I agree that while yesterday was quite a day, there was a lot of anxiety and obviously we all know how the markets were reacting. But contrary to what we thought, investors have actually tried to capitalize with the correction coming in. And we've seen some very good inflows. And inflows continue today as well. So yesterday was actually one of our best days for the collection. So I think the maturity level of the investors to buy on dips is quite visible now.
Okay, but there were redemptions as well. This is what you're saying is that I'm guessing people were sitting on cash and they were waiting to deploy, but there were redemptions as well.
Yes, Alex. So what we saw in the last 2 weeks were that the HNIs and some family offices did take cash call, and they were sitting on sidelines for clarity on the elections. Once the results were out yesterday, and obviously markets were a little jittery, and it corrected, and therefore I think they have taken the advantage of coming back into the markets, and that's how the flows have come back.
All right, so significant statements coming from multiple mutual fund houses. But let's talk about the direction that you should take and the strategy that you should employ. Does that change at all? Joining me now is Vishal Dhawan, the founder and Chief Executive Officer of Plan Ahead Wealth Advisors. Thanks so much, Vishal, as always, for taking the time. Appreciate your patience. What is the kind of conversation that you've been having with your clients? Have you gotten several frenetic calls yesterday? And I was saying at the start today, they say in Mumbai, "Kai ko tension lene ka." If you had not looked at your portfolio this week, and you pretty much be where you were last week.
Yeah, actually, I think, big events like we had yesterday just accentuate everything in the minds of investors very often. And, obviously, when you see a headline which says markets are down 4%, 5%, 6%, and so on, it does create some level of either anxiety or opportunity. I think the reality of what actually happened was that where the markets closed yesterday was very close to where they were actually closed on May 10th. And therefore, if you look at it over the last 3 or 4 weeks, the markets are where they were. Something has happened along the way in terms of an election outcome, which was already a journey that had sort of started with voting happening in about 6-7 weeks ago. So I think this has just been a journey. I think we've been telling investors that at both the extremes, you need to be careful. There was a set of investors yesterday who were like, let's go and buy aggressively because markets are correcting. And we had to tell them and remind them about valuations and, the need to be framing their expectations correctly that, we are where we were about a month ago. And on the other side, there was another set of investors who were, there is so much of uncertainty going to lie ahead. So why don't I move to cash because markets are going to go lower and therefore I can come back and buy it. So I think depending on different investor views, we had to tailor our conversation to what their needs were. I think there were three fundamental things that we spoke about. Number one is ultimately you got to go back to earnings. If you believe that this event is going to have a big impact on earnings growth going forward, then I think you need to take action either way. Our view is that it's probably not an event which is going to change earnings dramatically unless we see actual policy change on the ground, which will only be known about a month from now. Second is that you are sitting in an equity market which is fairly premiumly priced, especially mid and small size companies. And even large caps are not really cheap. So we need to be mindful that every decision that we take to allocate to equity today needs to be done with a long enough investment horizon that you're not exposed to shocks that come from overvaluation. And the third thing is that don't do anything dramatic like stop your SIPs, stop STPs, try to shift your portfolio around too much, especially for a mutual fund investor, because we need to remember that every change also gets accompanied by money moving into cash temporarily by default, because there are redemption cycles that exist across product categories. And what might happen is by the time you redeem and want to come back somewhere else, etc., you might find that markets have reached a different level because 2 days have passed. So I think our sort of recommendation was largely stay the course. You need to have decided much before the election outcome what you wanted to do, and don't change it because you had something which was different from what you might have expected.
Okay. We're also trying to get Harshvardhan Rungta to join us, but in the meanwhile, let me come back to you on this one. While you were speaking, what I was playing up on the screen, Vishal, is the kind of change that we saw in the NAVs yesterday. And I do understand that one day doesn't really make a huge difference in the larger scheme of things, but it's still important for investors to pay attention to this. It's interesting because the large cap actively managed funds actually saw a larger decline vis-a-vis the benchmark as compared to the broader market actively managed funds, with both mid-cap and small-cap actively managed funds being able to protect investor wealth. How important is this downside protection, and should you adjust your choice of scheme based on what you see in these kind of events?
So I think it's a great point. So I think we need to break this up again into two parts. One is that we need to remember that a large cap fund, for example, is allowed to have up to 20% of their exposure outside of large caps as well from a regulatory perspective. And what you found is that over the last many months, a lot of large cap funds outperformed the benchmarks because of this exposure to mid and small caps as well. And what has happened is on the reverse, like yesterday, you probably saw them fall a little more because mid caps and small caps fell more than large caps did. So I think the way to look at this is, while it's important to look at it from a downside perspective, I think it's also important to remember what is it that you are seeking in your investment strategy. How do you look at downside capture and how do you look at upside capture as well? I think for aggressive investors, they want a very high level of upside capture by default. And therefore, very often that upside capture will come with a higher downside capture as well. And vice versa, for investors who are looking for a more stable experience, less volatility, they may want to keep in mind that they look for funds that are relatively less volatile and make their decisions accordingly. And again, a single day may not give you a clearer answer. They might actually have to go back to longer term data, look at how upside capture, downside capture works, and then use that in their fund selection strategy.
The last question that I will ask you is strategy, and you already pointed out this is not a time for drastic decision making, stopping of SIPs, STPs, etc. However, I think that these instances and these events are a great measure for your risk taking ability or your risk comfort, the comfort of how much risk you can take. Because if you had a sleepless night last night, then that's an indicator to you. Would you agree?
Oh, absolutely. I think when big events of this kind happen, and they are probably resulting in uncertain outcomes, I think it does give you a sense, though they're not perfect indicators, because one of the things that we've seen over the years is that a very short correction, which gets followed by a recovery, like we've seen today, tends to make investors very often as complacent as they were earlier, because the period for which the correction happens is very short. I think the true test of risk tolerance and risk ability, handling ability, comes when you actually have a correction that lasts for a sustained period of time. So I think one of the things that investors may want to be mindful of is that if they just feel that, they didn't feel uncomfortable yesterday, and therefore they have a much rather less tolerance than what they might have thought earlier, they need to test this out when there's a sustained correction for a longer period of time. Till they don't have that clarity, I think they might end up finding that they are just simply being tactical at this particular point, because every time in the past markets have actually corrected downwards, they've actually come back up pretty quickly. So the true test is, when a buy on dip strategy does not work. Right now, what has happened is for a fairly sustained period of time, a buy on dip strategy has worked very well.
Yeah, and based on the kind of flows that we've been seeing, Vishal, I don't think that that's going away anytime soon. Of course, we'll have to wait for another couple of days to try and see what the flows for the previous month were, and hopefully they were encouraging. But thanks so much for joining in, for giving us that perspective. I think it's useful to a lot of investors.
Thank you so much. Pleasure being here.
All right, now, look, I think the long and short of it is that if you have a time horizon of the next 5 to 7 years at the very least, then events such as yesterday and the rebound of today should not worry you too much. Having said that, if you have gotten a jolt and if you were uncomfortable based on the kind of move that you saw yesterday, then it's perhaps because you might just have too much risk in your portfolio than you are comfortable with. We do discuss equity portfolios and mutual fund schemes in a lot of detail over the course of the week, so that I'd invite you to log in to the website, or in fact any of our social media platforms, or watch the show live on NDTV Profit at 1:30 p.m. every day. Do stay tuned.